All right, so we're going to do something a little different today. We are going to become Warren Buffett for a little while. We are going to try to decide what to do with the $189 billion of cash that is sitting on Berkshire Hathaway's balance sheet. Before we dive in, please take a minute and check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy right now from our sponsor, The Motley Fool. It's the best way to support this work we're doing on YouTube. Again, that is fool.com/Frankel. So I can go ahead and kick it off because, like I mentioned, Berkshire has $189 billion of cash. Warren Buffett has said that he insists on keeping about 30 billion at all times for, just general financial flexibility, having reserves, having liquidity. That still leaves almost $160 billion that Berkshire could use to buy something, to buy, well, probably more than one thing, honestly. And there's an argument to be made that they can even use more than that because Berkshire has stellar credit. So with borrowing capacity, they could even, make a potentially bigger acquisition. But it's really hard. Tyler and I were talking before this. It's really hard to find undervalued $100 billion companies. There just aren't that many of them, and the market tends to price them pretty fairly. Um, but I'll go ahead and start. One that I've said before that Berkshire should acquire is Starbucks, ticker symbol SBUX, and I feel even more so now. Starbucks issued disappointing earnings. They're still very profitable, but they issued disappointing earnings. The stock dropped by almost 20% after its earnings report, and it now is at an $88 billion market cap. So Berkshire could literally buy Starbucks and have $100 billion left over. They probably have to pay a premium to buy the whole thing, but you get the point. It's well within their realm. So there's a few reasons I think they should buy Starbucks. One, Buffett just likes food service businesses and the economics of them. He owns a lot of Coca-Cola stock. Berkshire itself owns Dairy Queen. Every time you eat at Dairy Queen, you're making Warren Buffett that much richer. So the reason that Starbucks dropped, and it dropped for a reason, same store sales came in way under expectations. They were down 4% year over year, as opposed to a 1% increase that was expected. Customer traffic dropped by 6%. And but on the other side, these are temporary headwinds. This is a company that sells a luxury item. Starbucks coffee is a luxury item. You don't have to spend $6 or $7 to get caffeine. You can do it a much cheaper way. I mean, I make a K cup downstairs. It probably costs me about 50 cents. So these are temporary problems. It's a tough environment for consumer spending. Starbucks isn't the only one seeing consumers pull back. Look at Kohl's stock today is down because people are spending less there. Just to name one example, but there have been a bunch this earnings season. Um, and the company is focused on a lot of the right things. They're focused on cost savings, increasing margins. Starbucks is still a pretty high margin business. Over the past 12 months, they've had a net margin over 11%, which, having been in the restaurant business years ago, that's an impressive food service business. Profit margin. It's trading at its lowest forward PE, right about 20, since the original 2020 COVID crash. It has about a 3% dividend yield. The reason I don't think Buffett would be interested right now, Starbucks generated 3.8 billion in free cash flow over the last 12 months. That's roughly a 4.5% free cash flow yield on its market cap. Buffett gets more than that from treasuries right now. It kind of reminds me of a situation a few years ago. Remember, a few years ago, before Buffett owned Bank of America stock, he owned Bank of America warrants that he acquired during the financial crisis that could be converted into stock at a certain price. And the reason he wouldn't do it, even though Bank of America stock was going up and up and up, was because the dividends, the cash flow he was getting from the preferred stock, was more than the dividends that Bank of America was paying out. And he said as soon as the cash flow he could get from buying Bank of America stock would exceed the preferred, that's when he would do the conversion. And it's a similar situation. If an investment has to give him a better yield on cost than he can get from treasuries right now, or else he's just not going to be interested. He doesn't want a stock that isn't going to be very free cash flow positive, or a company that's not going to be very free cash flow positive to the tune of well over the 5% ish yield that he's getting on treasuries. So that's why I don't think he would do this unless it dropped significantly. I could be surprised, but Buffett generally wants significantly more free cash flow than he can get from a risk-free instrument. Um, Tyler, I know you said that the $100 billion deals are not very easy to find. What are you thinking?
Yeah, I just to kind of put a pin, like to contextualize what this really means, right? Like if you want to do one of these big gun sort of investments, I was just looking. There's about 20 companies between 125 and 150 billion dollar market cap, right? Which if you leave a $30 billion cushion, that's what we would be, what we're considering here, right? Something that's going to move the needle, but leave some cash on the table afterwards. With 20 companies in that of the 20 companies in that region, like I'm trying to look of the ones that trade for less than 30 times earnings right now are, let's see, Comcast, woof. Union Pacific, I can't even acquire that because it owns Burlington Northern Santa Fe already. AT&T, woof. And then ConocoPhillips, which it already owns a lot of Chevron and Occidental Petroleum. And with ConocoPhillips doing the merger with Marathon Oil, that's all of a sudden going to be a heck of a lot easier. So we're talking about a portion of the market is really slim pickings here, right? Like valuations are very high in this particular part of the market, and there's not a lot in there that makes a lot of sense. The thing to me, and this is where I've kind of always thought Berkshire would go because it made sense to me, was home builders, because one, it bought some home builders for the portfolio in terms of publicly traded, and it also owns several building products, building a product adjacent wholly owned businesses. Clayton Homes is a manufactured home builder, and they has Acme, John Mansville. There's a whole bunch of like building product companies already in the operating portfolio. So it kind of makes sense that building and construction would be a place that Buffett would want to go. And home builders typically over the past few years have traded in the single digit price to earnings ratio, despite the fact that it's been a tough couple of years just post COVID, but at the same time there's still a structural deficit of housing in the United States. So there's a nice long runway in terms of adding new supply to the market at very profitable rates. So the challenge is when you get into trying to buy a home builder for Berkshire, nothing really moves the needle, right? I think that DR Horton and Lennar both kind of switch back and forth between like the largest home builders in the country, and DR Horton is 47 billion. Lennar is somewhere right around there at the same time. So we're talking about like if you really wanted to pull out the elephant gun, if you will, in terms of going after the home builder industry, you'd have to buy like two or three of them all at once to really be a needle moving sort of thing. And that's just something you don't really see Berkshire going to do. And this makes for a fun conversation times. A lot of people like to trot out their favorite stocks when it comes to, oh, Berkshire should do this because I like these companies. But when you start to like put the numbers around like what it would take to really move the needle for Berkshire, and where that part of the market is valued, it gets really, really hard. And like, let's be honest here, the market is somewhere near all-time highs. Valuations are at some of their highest like we've seen ever in terms of like, the aggregate PE of the market. I know that's heavily weighted towards the Nvidias of the world that are, I don't know, 70, 80 times earnings right now. I can't even remember what it is, but it's very high. And so when you have things like that influence in the market, it's going to be really hard to find deals. There's part of me that says that, like you were saying with incremental cash, like I can just sit on treasuries at 5% and wait for a pitch. Look, we are going to see some decline. We're going to see some recession in the future. We're going to see some sort of, market sentiment change where things are going to be trading for much lower multiples. I mean, I could pull the grandpa back in my day. I remember when Apple was trading for 13 times earnings, which is, not wrong. We've seen it before. And so when you have things like that, it kind of puts an emphasis on the idea of like, it's there's really no issue in waiting. And when you have an attractive option of 5% yield just from doing absolutely nothing, that can be pretty good for a little while. And certainly that seems to be the case with Buffett. And barring any very major surprises of maybe some things outside the United States, I don't see anything happening anytime soon.
Yeah, I mean, if I had $190 billion of cash and could get a 5% guaranteed yield on it, I probably wouldn't feel the need to do anything extraordinary with my money. So I understand that. I was more eager for Berkshire to put its money to work back when it was getting, 0.1% on its treasuries, and that was just kind of sitting there at zero earnings. But now that's almost a $10 billion a year source of profit for the company. So
Yeah, it's a productive asset over inflation.
I want to thank the Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with the Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.